Welcome back to Good Revenue. We're here today with Michael Frankel. He's the founder and managing partner of Trajectory Capital. And in addition to having a really rich and interesting career in M&A, he's done more than 100 M&A deals, which I think is incredible. Welcome, Michael. Thank you so much for joining us.
Thanks for having me.
I'd love to just jump right in if you're game. With more than 100 deals in your history, I just love to get a sense of what is your process and the general approach that you use when you're looking at M&A deals. And I have both sides of the deal.
So I think in most things, preparation is a lot on the buy side. And I find that the actual M&A transaction is like a water slide. Once you start down, you're going down at a certain speed and you can't really slow down or stop. Prep is really important. So on the buy side, do your M&A strategy in advance, know what it is you're looking to buy, why you're looking to buy, at least have hypotheses about what are the synergies going to be, what works and doesn't work for you as a buyer. You have hopefully some history and we are just terrible at integrating this kind of business or that kind of business. Or at the very least, here are the things that went wrong in the past. Understand what your process is going to be once you identify a target. How are you going to evaluate your internal decision-making process? In the case of corporates, that can actually be a big problem. Have you identified all the stakeholders who either get to have an opinion or get to have a veto? Wrangling all of that will make a huge difference when you get into the process. And the other thing I'd say, especially for large corporate buyers, is resources. It takes a village. In a corporate M&A transaction, the actual corporate development team usually represents no more than 10% of the resource associated with the deal. You have subject matter experts, the operating business that's going to absorb the acquisition. You have enabling areas, finance, HR, IT, legal, real estate. And so making sure who's doing what, ideally they've done deals before. If they haven't done deals before, get them prepped, have all your ducks in a row before you start the deal process, I think is incredibly valuable. Put it in an extreme case. I had one transaction I worked on. There were 3 corporate development people and a total of 111 non-corporate development people involved. The fact that we were able to orchestrate all those people made a huge difference. Now, that's an extreme case, but the ratio is often at least 10 to 1. So then once you're in the deal, having a playbook for, before you get into the deal, playbook for how you source deals. I tend to be a very active sourcer. I think passive sourcing is dangerous because you either get the deals that are not as interesting or the deals that have been picked over by others. And I'll give you a great example. On the buy side, there was one deal where we identified the company as being interesting. The founder had no interest in selling, but someone from my team spent 2 years developing a relationship with the founder. Quarterly conversations, occasionally when they were in the same city, they had a meal. And that provided us with a whole bunch of pre-diligence. We knew a whole lot more about the business than anybody else did. We were pre-vetted as nice people. Anybody wants to avoid jerks in any part of the process, but certainly if you're selling the thing you've built over a 30-year period, building that relationship turned into a huge advantage in not only getting access to the deal, but getting the deal done. Being really thoughtful and proactive in your sourcing is another tool. I'll give you one example in that area. Oftentimes, one of the best sourcing engines you have is your sales organization. Your sales organization is out in the market talking to everyone. And sitting at a bar at a conference, you find out a lot about other little companies. You either find out indirectly, oh yeah, one of my vendors sounds like they're going to sell, or the founder of the company going, yeah, I think I've done this a long time. I think I want to sell. Going outside of your own corp dev team and a banker community can yield a lot of great market intelligence. Then once you're in the process, diligence, there's a rigor to doing diligence and there's a playbook to doing it efficiently. And by the way, again, going back to the no jerk rule, you can do diligence in a way that makes it as painless or as painful as possible for the counterparty. And that could actually damage the relationship. Integration planning is not something done after you close the deal. It's done in tandem with the diligence process. I view it as a virtuous cycle between integration, planning, diligence, and negotiation. You discover things in diligence which affect integration planning, which in turn affect the terms on which you're willing to do the deal. And it goes round and round. Having a playbook Doesn't mean it has to be rigid. You will flex, because one of the things I love about M&A is every deal is different, and that's what's fun about it. But having a playbook, understanding what your goals are, understanding what your resources are in advance throughout the whole process makes a huge difference, especially when you try to do something at scale. If you're trying to do 5 or 10 deals a year, if you don't have playbooks, toolkits, processes, you just won't be able to get it done. And then the last point that I'll make, and this is a theme throughout our whole conversation, is either on the buy side or the sell side, understand what your value drivers actually are. The obvious one is always purchase price, and that's the easiest one. One of the beautiful plants behind you, I would like to pay $5 and you would like to get $10, and we maybe negotiate our way to $7.50. In almost every case, there are other non-price variables that can drive value. And that's the whole 1 + 1 = 3 thing dynamic that I like about M&A, but that requires a lot of sort of diligence on the counterparty, but also self-awareness, right? And even more so self-awareness. What do I actually want? What does my organization actually want out of either this acquisition or this divestiture? And I think doing that work up front is incredibly important, because in the heat of the moment, when you're halfway down the water slide, that's a tough time to go to your leadership and go, do we actually care if we keep this brand?
There is so much in that. I have a million questions I want to ask you, but maybe
Please.
starting with one of your points there. In terms of value drivers, I totally agree that honest self-assessment, I suspect, is where a lot of that hinges. But also, it seems to me that having some understanding of what the acquirer actually wants, there's almost that mutual discovery process. But I'm curious, do you have any recommendations in terms of what a seller could do to really get more honest with themselves about those value drivers?
Absolutely. Part of it is, if you're on the seller side, especially if you've got founder-owned businesses rather than professionally owned businesses, what do you actually want out of your life over the next few years? Set aside price. Obviously, nobody has ever said, I would like you to pay me less for my business.
Sure.
Exactly. Yeah.
Yeah.
So understood price, but what else do you care about? And maybe a good way of thinking about it is, I'm now going to make a reference that's only going to appeal to the oldest of your viewers. The old, this is your brain on drugs commercial. Imagine post-transaction life. So if you're a seller, do you care what happens to your business? Do you care what happens to your employees? Do you care what happens to your customers? Do you care what happens to your brand? Do you care what happens to you? Do you want to be involved in the business, not involved in the business? Do you want upside because you think the business is going to continue to be successful, or do you not, right? How much capital do you want to put into your life? So on the sell side, and it can, even if you're a professional seller, do you want a relationship with this buyer? Do you care how it's publicly perceived that you did this sale? And then on the corporate sell side, even more variables could come into play. So as an example, what kind of legal liabilities are you comfortable taking on, not taking on? How do you want your customers to perceive this sell event? How do you want your employees to perceive this sell event? Do you want to have any ongoing relationship with this business that you're selling? Maybe you want to keep licensing the technology. Maybe it's not core to you, but you still want to keep selling it because that's free money. That's high margin revenue. So really getting an understanding of what you want the end state to look like optimally for you, you can then reverse engineer and go, okay, if that's where I want us to end up, here are the 17 things other than purchase price that I want, that matter to me. And you should at the same time basically be doing that psychic exercise for your counterparty. This is what I want. And I think Neeta, I'm going to have to ask her, but I think she probably wants A, B, C, D, E. And maybe that's part of the initial conversation where I ask you, what do you want other than to sell that business or buy that business? And then that helps construct that 1 + 1 = 3 scenario, where you give me things that you don't value and I give you things that I don't value. And it makes us both better off, regardless of where we end up on the dance of purchase price.
Yeah. Switching gears a little bit, maybe just to the fact that obviously the IPO markets have been pretty stagnant, I think everyone would say, for the last couple of years.
Mhm.
And M&A seems to also be up and down, and maybe is a little quieter than folks had expected. And one of the data points that I find to be really fascinating is the level of change in profitability. And one of the stats I've seen is that in 1980, 78% of VC-backed IPOs were profitable. And in 2022, none of the 13 companies were profitable. And I just think that is amazing because we spent a lot of time here thinking about business models and monetization. So I'm curious to know, what are some of the lurking problems for sellers in a market environment like this?
Yeah. So I think one of the biggest ones is uncertainty about what the steady state is on valuation, on access to IPO, and on access to other capital, right? If you think about it, the more information you and I have as counterparties, the more likely we are to know where fair lies. And then we negotiate, but we negotiate around the edges, right? So if we're pretty clear that your business is worth between 10 and $11 million, we're probably reaching a deal, right? It's going to be 10 point something. The problem occurs when there are data points indicating your business is worth $100 million, and there are data points indicating your business is worth $5 million, right? The wider that
Spread,
space,
yeah.
exactly, the less likely it is that we're going to end up someplace that we both think is fair and that doesn't turn us off. And the same thing is true for alternatives, right? In a world where you know that either you absolutely cannot IPO or you absolutely can IPO, you know what your next best alternative is. We're living in an environment where you could be able to IPO, and that creates this weird uncertainty. And the same thing with access to capital, right? In a market where there's no capital, there's no alternative. In the market where there's infinite capital and you're getting term sheets every day, same thing. This environment last year and this year feel like in some ways the worst of all worlds, where there's just a lot of uncertainty.
Yeah.
And uncertainty creates a challenge to a meeting of the minds. So I think that's all those variables are making it harder to get deals done. And they're also making it harder they're making it harder for sellers because they don't know what's fair. And there's always a little bit of FOMO when you're in a down market, because you think to yourself, but maybe I should have sold in 2021.
Yeah.
Maybe 2025 will be like 2021. And on the buy side, I've got a lot of budget pressure. There are a lot more eyes on my performance. In a hot market, if a deal doesn't go well, nobody really notices, right? It gets buried under all the other good news. In a tough market, I'm going to be watched very carefully. So there's just a lot more uncertainty that now is the right time and this is the right deal. And I think that just makes it hard for meetings of the mind.
What do you companies should be doing this year to potentially address that?
Yeah. So a few things. Number one, don't think about what might be, right? Because what might be, there's an infinite range of possibilities. The question is, what are you trying to get out of your business? So if you're trying to buy, if you're an acquirer, you should be thinking long-term, right? And there's a price point at which it makes sense to buy right now, unless you just don't have the capital. If you're a seller, there's a reason that you're thinking about selling. And those things probably hold true even in a down market. I think being really clear about what you want and how important it is that it happen now is a big first step. And setting aside the FOMO thing, right? Nobody ever sells at the peak.
Yeah.
So trying to sell at the peak is a bad strategy. Now, there may be better times to sell if you're still enjoying running your business, if the business is still bringing value to the parent company. And flip side, on the buy side, maybe right now you've got too many distractions to properly integrate. Things like those are good reasons to hold off, but not because you think that there might be a better time. You'll never catch the top of the wave. So that's step one, is be very self-aware and honest with yourself about what are your goals and determining whether this is the right time to act in any way. On the sell side, and this gets into a much broader topic, I am a huge advocate of prep for sale. The most heartbreaking thing for me, I spent most of my career as a corporate buyer. The most heartbreaking thing for me is to see a business and think to myself, if they had done these 5, 8 things over the last couple of years, I'd pay them 30% more for this business happily. And so if you're a seller, and this is true even of corporate sellers, I'm surprised at how often corporate sellers don't do this as well, but certainly for founder sellers and VC and PE sellers, actually stepping back and saying, who are my likely buyers? what's going to matter to them? How do I prepare the business? This doesn't mean take the business off the rails, right? First and foremost, you keep growing the business. You make the right business decisions, but there are often a bunch of things that you can do to optimize the business for sale that take a year or two to do. And so even if you're not ready to sell right now, if you can see a sale on the horizon, prepping. In some ways, it's the mirror image of what a buyer should be doing, right? Market mapping, identifying what are the things you'd want to buy, who are the potential assets out there, how would they fit in, how do I start to get to know them, all those kinds of things, right? The flip side on the sell side is how do you prepare your business to be optimal for a buyer? Because as a general matter, especially corporate buyers, it costs them dramatically more to fix things than it costs you. And they're risk averse. A $1 risk to you is probably a $3 risk to them.
Where do you think sellers go kind of off the rails or off the reservation here? If a seller actually I think every seller wants to expand their exit opportunities.
Yeah.
So maybe the better question is like, what is getting in the way of them making some of those choices 18 months or 2 years before they want to sell?
I use a couple of things. One is not being willing to internalize the idea that they're selling. So
like an emotional block almost on that.
A little bit of an emotional block.
Yeah.
And I will sound like a crotchety old man when I say this, but I think in the last 20, 30 years, the idea that everyone is going to IPO has gotten into everyone's heads. And we all know statistically that a tiny percentage of even successful businesses end up as public companies. The vast majority of even successful businesses, I'm not talking about ones that fail, successful businesses end up being sold. But somehow everyone thinks that they are going to be the one that IPOs, and the path to IPO is very different than the path to sale. So the first thing is to just accept that's your likely outcome. And you'll know if it's your likely outcome, right? If somebody isn't putting hundreds of millions of dollars on your balance sheet, that's probably your likely outcome. The second is not thinking about your business as a subsidiary, because the things, and there's a little bit of a dance you have to play here, right? There are the things you do if you're on the path to an IPO. There are the things you do if you're not necessarily on the path to an IPO, but you're just trying to grow your business. And then there are the things you do to optimize your business for a buyer. And I would argue for most people, ignore this one and balance this one and this one, right? Try to first and foremost grow your business, because that's really how you add the most value. But once you're growing your business, think about what will make it a good subsidiary. And that can be, it's a wide range of things, but I'll give you an example. One is identify all your natural buyers, make sure they are aware of you. Maybe start to cut ecosystem deals with them, which is a win, because your worst case scenario is helps drive revenue to your business. Your best case scenario is it causes them to fall in love with you, become dependent on you. You become part of their product suite. And when you're ready to sell, they have an even greater incentive, right? Because now not only does not buying you lose them the opportunity to have you, but it probably loses them a pool of existing revenue that we've established that you're doing together. Prepare your business for sale. This is one thing that always drives me bonkers. Recognize, no matter how sincere you are, if I'm going to hand you what I call boat money or plane money, you need to have a successor on your bench, because statistically, the chance that a founder who has taken 8 figures off the table stays in a large corporate bureaucracy filling out TPS cover sheets is relatively low.
Yeah.
As a buyer, I go, when that founder 6 months in goes, I've had enough of this, and walks away,
what's our plan? Yeah.
Who knows everything that founder knows? Maybe. And there is a laundry list of other things you can do. Market standard contracts. Don't use open source code in places where you'll get sued. This is I think a great example. There are all these little companies that use open source code and go, nobody's going to sue me. That's right. But 3 seconds after I buy you, they will sue me. And so I'm going to tear all that code out, and I'm going to budget my super expensive dev team to rebuild it all. Make sure that you have a good brand in the market. Even things like, and this should go without saying, but have an HR appropriate environment. Don't tolerate bad behavior in your organization, because you should care about it. But if you don't care about it, your buyer will care about it. And I'll be honest, I have walked away from a deal because of culture issues within the target. So There are a whole bunch of these different topics, but prepping your business for that sale is a great way to enhance value. It's always surprising to me that someone will spend 10 years of their lives building something, but they won't spend a relatively modest amount of effort shining the apple, which can add 10, 20, 30% to the purchase price and increase the likelihood of a sale.
Sometimes it seems to me that if you're in a company for too long and particularly if it's one that you've built or helped to shape, it's hard to have that critical eye. I think that's hard for a lot of us.
100%. Yeah. And part of it is if you live inside the bubble, everything looks like a bubble.
Yeah.
And part of it is, and I am not a founder for this reason, it takes a certain amount of irrational exuberance to be a founder, which is fantastic. But you have to walk that balance of being irrationally exuberant when you found something, but being open to taking advice. It leads to a piece of guidance. I would argue that everybody needs advice. Everyone needs advisors. And certainly if you're on the sell side, I think it is very wise to arm yourself with people who can help you with everything from M&A experts who know how to prep for sale to industry experts who know what large acquirers are looking for, who else is in the market, what the dynamics of the market is, where it's going in terms of feature functionality so that you can build to where your buyers are going to want to go, all those kinds of things. And whether it's a founder or a seller or a buyer, being open-minded enough to go, I know a lot, but I don't know everything. And let me arm myself with some really smart people, I think makes a huge difference.
Yeah, I also really think that's what we should be rewarding too for me, just to meet those opinions on the world here. But how important is it from your point of view too, to get the business model and the pricing right in terms of being able to sell well?
I think it's huge. I think the only exception is very early stage companies where you're effectively selling a technology.
Sure. Or you're acqui-hiring for the people, right?
Exactly. Yeah. Hopefully not an acqui-hire because that usually means the product failed. But yeah, if it's an acqui-hire, it doesn't matter. Or if you're selling a technology where the buyer is going to throw your pricing model and your business model out the window and just embed it into what they're doing, then it doesn't matter. But for any other business, it matters in my mind, for a couple of reasons. The first one is it's how you will optimize your business. If you're leaving money on the table from a pricing perspective, that means you're not growing your revenue as fast as you could. Or if you have the wrong business model for delivery, for services, for how you approach customer success, for whether or not you have channel partnerships, like there's a whole bunch of business models, this incredibly broad term, even recurring revenue, not recurring revenue. This gets back into pricing, seats versus enterprise licenses. All of that stuff optimizes a business in two ways. The first one is, as a standalone business, it just makes the business more successful, right? You get more revenue, you get more profit, but it also makes the business more attractive to a buyer, right? Not just because you get a double benefit. The first benefit is you have 6 million of revenue instead of 5 million of revenue. That's 20% better.
Yep.
But number two, the buyer looks and goes, that's one thing I don't have to fix. And by the way, you don't just have to optimize those things, but you have to provide the buyer with proof. So it's not just, I know my pricing is right. It's, here are the pricing studies I've done to prove to you that my pricing is right, so that you know that you're not going to have to go and shred all these contracts and start from scratch. So I think it's important for both reasons. And it's something that tends to be ignored because in my experience, companies are founded first and foremost, usually by product people, right? They have an idea for a widget. They're passionate about the widget. They're an expert on the widget. They build the widget, and then they just want to get the widget out there.
Yeah.
So they're not going to focus on business model. They're not going to focus on pricing. And by the way, I'm not saying that you shouldn't give discounts and things like that to get out into the market, but that doesn't mean having a bad pricing model. That means having a very conscious discounting program where you go, Neeta, you're my first anchor client. I'm going to give you a proof of concept for free, and then I'm going to give you a 70% discount on my standard rack rates. That's fine, as long as we're clear, this is my price, but because you're a special customer, it goes down here. So I think building all of that stuff is, number one, unnatural for founders. And this is where I think there's the sort of culture of venture and seed investing can be a little bit dangerous because, and I don't think VCs and seed investors do this, but the impact of so many very famous, massive home runs has trained a lot of founders to think None of that matters. Operating model doesn't matter. Pricing doesn't matter, because if I make the next Google, it'll all get fixed in post. I just have to make this thing, and then the thing will become gigantic. And once I hit $1 billion in revenue, then I'll hire somebody to fix my pricing. The problem is that 99.9% of companies, even after they're successful, do not rocket ship up to $1 billion. And this is where I sound like an old guy. We used to think that a business that went from 1 million of revenue to 8 million of revenue was a fantastic business. You've got someone to pay you $8 million a year for your thing.
Yep.
Now there's this sort of all or nothing expectation. And I think it creates an adverse incentive not to go after basic operational improvement that is boring to some people, but really adds fundamental value to a business.
I totally agree with you. And what I find fascinating too is, in my experience, when you are doing the work to really understand and validate customer value and then build from that into a pricing or a business model, and that may be a question of the segment that Michael lives in is subscription, but Neeta is more of a transactional, a low frequency, low utility buyer. I should have a different business model. Otherwise, I'm going to bypass this. Which is, again, it's back to this core. I'm sure our listeners are tired of me sometimes talking about segmentation all the time, but it feels such an easier way, frankly, to build a business. And I get that, like in the early stages, to your point, if it's an earlier, like a sub 10 million revenue company, it is sometimes harder, I think, to get this right. But I don't think you have a lot of excuses once you're at like 8, 10 million to not be able to figure out like who cares the most and what are they willing to pay for whatever you're doing. Is that fair to say, or am I being too hard on people?
In fact, I would go further and say, I would argue that even a sub $10 million business should have some level of insight into this for this reason.
Good. That makes me feel better.
Yeah. Any good business is founded on a good product.
Sure.
And any good product must be informed by an understanding of the customer need, the customer problem, the way the customer operates, and the competitive dynamic, right? So if you know those things, you should be able to apply them to at least what I would call remedial pricing optimization. So maybe you can't optimize to the last penny of the price that you could extract, but you should understand enough about your customers to know roughly what pricing model should work. Is it seats? Is it subscription? Is it one time? Is it volume based? And about what level of price still delivers a value to them, right? But extracts a decent amount of value for you. And the same thing with other parts of the operating models. Can you get to the 90th percentile of accuracy and efficiency on those issues as a $5 million company? No, and you shouldn't, but you should be able to get to the 50th percentile, right? You should be able to kill off the low-hanging fruit and say, I understand my customers, I understand the problem solving for them enough to get generally into the right neighborhood.
I think it also helps you build better products. Like to your point, if the product is the core and you're in love with the widget, like again, that value conversation is so important. The other thing that I find, I'm curious if you see this too, is I find a lot of founders in particular confuse benefits and value. Benefits being anticipated utility and value being what will Michael actually pay me for my widget. And I feel like once you get that distinction, it's such an unlock. And the other thing that almost feels like an emotional reaction is sometimes when on our end, when we go through that process, what happens is that someone has built something, particularly in technology, that was really laborious or time consuming to put together, but it has low value to the customer. And that can be like a hard, almost emotional moment.
Oh,
Does that come up in M&A too, where like valuations, I would imagine, but
that's the problem is valuations that are tied to how much effort you put in, or to how much value, even to how much value you're extracting right now from the customer, have no benefit, right? Valuation is always future facing. If you created a widget that at the time you created it was totally unique, but 17 competitors have announced identical widgets coming onto the market, you've lost that value.
It's commoditized, yes.
It's commoditized. You have to accept that, right? And this gets back to that theme at the beginning of understanding your counterparty. You have to understand your buyer. Your business is only as valuable as it is to the other party. It's not a matter of how much effort you put in or how valuable it is to you psychically or emotionally or even financially. It's it's going to, the breaking price is going to be what it's worth to the other party minus at least $1.
Right. Yeah, I like that. I think that's exactly right. Yeah. And in our parlance, like I really like the framework of need, value, and willingness to pay. And what I
Yeah.
hear you say is the same is true on the acquisition question.
Oh yeah, exactly. As if you think about it, an acquisition is just a one-time purchase of a unique product, right?
Yep.
It's a pair of pants. It's just a pair of pants that were hand sewn.
Expensive pants.
Sure. Expensive, and they're never going to make another pair of pants
Right.
exactly like it. But it's the same. It's the same, and it's more complex, right? It's pants with a whole bunch of different variables and feature functionality, but it's the same logic chain. Yeah, it is amazing to me on the pricing front how rare it is to find a company that, and I'm not just talking about small companies, I'm talking about big companies that can show me on a piece of paper, here's the quantitative value we are creating for the customer. Here is or I should put it here, here is our cost to create that value. And here is where the competitor is. And I should be able to price somewhere between here and here. And by the way, if that second line is above the first line, get out of the business.
Yeah, you got a different
Right?
problem.
It doesn't matter how great you think the thing is. If it costs you $10 to make the pants and everyone thinks they're worth $9, it's amazing. And those are fairly simple, straightforward concepts. Coming up with the data is really hard work, and there's an art to it. But the basic concept that something creates X dollars of value for someone else costs you Y dollars to create, and there's somebody else out there that creates something similar that creates Z dollars of value for the client, and you use those three numbers to figure out where you can effectively price. That's a pretty straightforward concept. And to the point earlier about sub $10 million companies, you probably can't do the work to have very specific quantitative analysis of all three of those data points for 100 different customer segments in different markets.
Right.
But you should be able to have a rough sense for your core customer of where those three numbers fall.
Absolutely. And there's a rule of power law in there too, right? There's some customers that are going to be worth more than others. You should still do your segments. It might be one, it might be three, maybe it's five in a really big business, but yeah.
You won't do the kind of customer segmentation that the world's largest retailer does, thousands of different customer segments.
And they have thousands of different problems or products too that they're selling. Sorry to interrupt you, but they're approaching that market differently. They're not selling the same widget to a billion people.
That's right. Yeah. And a lot of this is commonsensical, but I think it's very easy to the bubble reference.
Yeah.
It's very easy to get caught up in your business and not challenge yourself to think about these things. Ironically, especially if you're being successful, right? If you're about to fail, massive failure causes people to become very realistic and very open to feedback very quickly. What drives me nuts is people who are, and I'll use the sports analogy, people who are hitting us double and are totally unaware that they could be hitting a triple. Because they're so proud of the fact that they're hitting a double, they're not willing to listen to feedback.
And it's interesting because when you're saying this, what I'm thinking about is that some of this is so easily solved just by talking to customers, right? And you're alluding to it. But I think a really simple process around qualitative and quantitative market insights on a regular basis would be huge for almost any business, certainly one that has a wider potential. And what I find really interesting is, in my experience, even very large companies with whom we have worked will often benchmark off of the competitors, like just what the pricing is. And then my sense is that no one has actually done the market research.
Exactly. Everyone's just following the leader.
Everyone's following the leader. And in pretty commoditized products too, where you're like, the competitive advantage here would be if we're the dominant one, we could cut the price, take market share, build from there. Or again, we build a golden widget or whatever and do something else with it. But anyway, it could be a really interesting strategic opportunity. And I wish more companies would take it, because I think it'd be fun.
I totally agree. And you can draw an analogy right back to M&A, right? Just, you can even go and ask the buyers the question. You can say to a large corporate, maybe you don't want to broach the subject of, do you want to buy my company? But that's why I think ecosystem partnerships are a great opportunity to go, if you were going to sell our offering, what would make you interested in selling our offering? What feature functionality? What do you think the realistic pricing is? What are your customers looking for? What would make our tool, product, whatever it is, an interesting part of your ecosystem? what I'm effectively asking you in a very delicate way is, what would cause you to want to buy me and pay the most for me? But you can do that through a pure reseller, ecosystem partner, white label kind of commercial conversation, and you get fantastic insights. In fact, you get even better insights than if we're talking about acquiring me, because now we don't have this weird adverse incentive of, I don't want to tell you that your business is too great because then I'll have to overpay for it.
Right. I love that. So just a slightly adjacent topic then, what about for corporate sellers? Like, to your point, the business isn't doing that well. We don't see potential, or our big picture strategy has evolved, and therefore this just isn't aligned anymore.
Yeah.
What is some of your advice in that situation?
So first of all, I think oftentimes the second scenario leads to the first scenario, right? In other words,
Yeah.
the divested assets in a large corporate, because if something is totally failing, large corporates are good at shutting things down, right? They're more willing to than a
Right.
firm. So in my experience, you have either businesses that are struggling because they're off strategy, and so they got starved of resources, or businesses that are doing well but are off strategy. And one of the things that I think a lot of people don't understand about large corporates is, in the grand scheme of their organization, something can be too small worth the trouble. So when large corporates, my advice to large corporates, what I tried to do when I was at one is, number one, don't be shy about evaluating something as off strategy. Don't wait for a down market to do those regular strategy reviews, because once something has implicitly been identified as off strategy, it will start to get damaged. It's the car where you don't do maintenance and you don't do an oil change and you leave it out in the rain. And it's better to pull the Band-Aid off quickly and decide this is off strategy. Not anybody's fault. We're not looking to blame. Our strategy is constantly evolving. The market's constantly evolving, but making those decisions quickly and definitively is step one. Step two is that self-awareness conversation. What do I actually value about the process of divesting this business? And the smaller it is, the less likely purchase price is to be the highest priority. Yes, if you are a $20 billion company selling $1 billion asset, yeah, you care about purchase price. That's very important. It's going to materially affect your balance sheet, what you get for it. But if you're selling a relatively small part of your company, I would predict almost never is purchase price the most important variable. You want your customers to be taken care of, because, as an example, if I sell a customer a product, I probably sell them many products. And even if I divest the business, they're still going to blame me if they have a bad customer experience. In my experience, it takes 1 or 2 years, or at least one renewal cycle, before a customer will let the parent company off the hook for a bad experience.
So you're going to incur the reputational risk, basically.
Exactly.
Right?
So I want my customers taken care of, because the $20,000 contract that I'm selling with this business may be attached to a customer who buys $2 million of stuff from me. I want the employees taken care of, because that blows back on my employee base and employee morale. I care about brand. Maybe I want to keep the technology. Maybe I'm using the technology. I integrated this business. I'm using the technology someplace else. Or the flip side is, maybe I want an ongoing revenue stream because I'm going to license something to this business, right? It's using my data and I'm going to keep my data, but I could license it. Maybe I want to keep selling it because I've trained all my salespeople in how to sell this thing. It's almost a costless exercise to keep it in their book of business. I just don't think it's strategic. I don't want to run the business right now. So there's all these different, legal liabilities is a big, if I'm a $20 billion business selling a $5 billion business, I will absorb a certain amount of legal risk to get the best price. If that's a $5 million business, my general counsel is going to say, I'm not putting our company at risk for this little tiny thing. So managing legal liabilities, what am I on the hook for, is going to be really important. Even brand reputation, right? Maybe I don't want everyone to know I sold this business and this is somehow perceived as a failure, right? I've even seen situations where the corporate says, we're not going to characterize this as a sale. We're going to keep 5% of the business and we're going to characterize it as a partnership. We're bringing in this buyer. So there's almost an infinite number of these different things that can be important depending on the nature of the asset being sold. So my biggest advice for my peers, my former peers who are corporate development officers, is force that conversation in the organization with your strategy lead, with your business lead, and be very direct with each other and go, okay, this is what actually matters in the sale of this business. And this is how we prioritize it, because that's how you're going to negotiate. And you might end up saying to a buyer, listen, I'm going to give you a very attractive purchase price. Good news for you. In exchange, I'll give you another example. You're going to sign a 3-year agreement that you're not going to do any ecosystem relationships with my direct competitors.
Mhm. Yeah, that
Right?
makes sense. Right.
Things like that. So yeah, identifying what actually matters to you and creating that basket is super important before you divest anything. And the smaller it is, the more likely it's going to be these non-quantitative things that you actually have to think about. And then think about who the natural buyers are who are willing to give you those things. So a good example would be, maybe that means you're not going to try to sell this to your direct competitor, even if they would pay you 30% more, because 30% more is $2 million, and you burned that on legal counsel just having this conversation.
Which they, I'm sure, don't want to necessarily think about. But
Yeah, there's a cost to everything. I will tell you, and this amazes some people I know who haven't spent time in large corporate. I have seen on multiple occasions, large corporates take small but profitable and growing businesses and shut them down, incurring severance expense because they didn't want to go to the trouble of selling.
oh,
So
wow.
literally, I know we could get $5 million for this, but I would rather get 0 and incur a $1 million liability in severance because I just want to be done with it. I have bigger fish to fry, right? My analogy would be, you've got a pack of gum in your pocket and the last stick of gum is sticking inside the pack. Maybe just throw away the pack.
But it sounds like you're encouraging them to maybe do just a little bit more work to actually mitigate some of the risks. Is that fair to say?
That's right.
Instead
I
of
think
just winding it down? Okay.
that's right. Yeah, because I think winding it down often has some non-quantitative damage as well. It has damage to employees. It has damage to ecosystem partners and to customers, right? Now you've got to contact all those customers and go, we no
Right.
longer support this widget that we sold you 1 to 10 years ago. So yeah, it gets to my first point, which is oftentimes the decision to shut down comes when the frustration level has boiled over, right? Because something has been off strategy and a source of annoyance for 2 or 3 years. And so leaders
Right.
finally go, enough. So that's why, as a corporate development leader, I tried to get to the thing that was determined to be off strategy as close to the moment where it was determined to be off strategy as possible. Don't let it fester.
Mm.
Because then you have the window of time and tolerance within the organization to get the most out of it, whether that's maximizing purchase price or ecosystem relationship or license revenue or brand in the market, whatever it is, you can squeeze as much juice out of that lemon as possible.
Michael, this has been such a great conversation. I really enjoyed it. Is there anything else that you would like to share with us before we get to our last question?
Sure. We touched on it, but I think it's really important. The beauty of M&A, the thing that makes M&A fun for me is 1 + 1 = 3. So I get no pleasure out of the tug of war of trying to threaten, cajole, or negotiate the extra dollar in the middle from you to me. I think the art of M&A that is so exciting is when you can find a way to turn a $10 asset into $15 of value split between the two parties. And key to that is being very self-aware and really understanding the counterparty, asking lots of questions. I'm always surprised at how few questions people ask a counterparty about what they want, what they're seeking, what their outcomes should be. How can you possibly construct an offer that optimizes value if you don't know those things? Asking questions, really understanding the counterparty, I think it makes a huge difference and makes it a whole lot more fun.
What do you think that high performance companies do differently from the run of the mill?
In particular with M&A, I would say professional corporate development talent. Corporate development is a specific skill. It's no different than marketing or HR. So having pro corporate development, number one. Number two, deep alignment between corporate development and strategy. Those two things it's hammer and nail. And so even if they don't report to the same person, they need to be tightly integrated. when you're in a deal, and we talked about this earlier, diligence, integration, and negotiation have to be aligned. This idea that diligence comes first and then integration comes afterwards is crazy to me. And then the last one is, and this is especially true for big corporates, recognizing the need to have the execution capabilities to capture synergies. Not to be snarky, but as a corporate development officer, it is super easy for me to model synergies. I put them into an Excel spreadsheet. The numbers look better. Everything turns black from red. Ta-da. The reality is actually making those synergies come true is a huge amount of work. There's the classic McKinsey study about how, this is now 30 years old, 70% of M&A transactions destroy value as opposed to creating it. Never about price. Nobody has ever done a deal, or very rarely has done a deal, said, if I'd paid 5% less or 10% less, this would have been a good deal. For corporates, because of that synergies factor, it all comes down to good execution. If you execute well, you always underpaid. If you execute badly, you always overpaid.
That's wonderful. What a great place to leave this conversation. Thank you so much for joining us. I hope you'll come back sometime and chat with us again. But it was great to have you. Thank you.
Thanks a lot.
Thanks for joining us here at Good Revenue. If you liked what you heard, please leave us a review, follow the show, or share it with a friend. We're a news show, so it really helps listeners find us. And if you have feedback, suggestions for episodes, or guests, reach out to us. You can find our in the show notes.